Let's go ahead and go through the solution to question 3 on the practice questions prior to the midterm. So we have here the same company we've had previously, a 70% owned subsidiary, earnings of $100,000 per year, dividends of $20,000 per year. All that stuff is the same as before. And now we have two intercompany bond transactions. We have the easy transaction. There's an upstream sale of bonds directly to the parent at face value, so that'll be very easy to account for. The second one, we have big company issuing bonds in the open market at the beginning of 2012 at a slight premium, and then 5 years later, 6 years later, Little comes along and buys those bonds, or half of the bonds on the open market at 103. So this is going to be, again, what's referred to as a constructive retirement, and this gets to be a little bit more involved. But first, let's go ahead and deal with the direct sale of bonds to the related party. Again, the best thing to do for these intercompany debt transactions is at the end of each year, go ahead and make a list of all of the accounts on the books of the issuer and the buyer related to the intercompany bond transaction. And again, for the bonds issued directly to the related party, it's very simple because one is simply a mirror image of the other. So Little, the issuer, is going to have on their balance, or is going to have on their ledger at the end of every year, they're going to have bonds payable of $100,000. There's no discount or premium, so they're going to have interest expense of 10% of $100,000 or $10,000. By the same token, Big the buyer is going to have an investment in bonds every year of $100,000, and they're going to have interest revenue of $10,000. So the elimination for these bonds obviously is very simple. We're simply going to close the payable against the investment and the expense against the revenue. There's no effect on income. It's simply a wash. Okay, next let's go ahead and move on to the constructive retirement bond issue. I'm going to make a little bit more room here, get those out of the way. The first thing we really should do is sort of nail down exactly how much the original premium is being amortized for. These bonds were originally issued back on January 1st, 2012 at a 2% or $4,000 premium. That $4,000 premium is being amortized over 10 years at $400 per year. And so when we go to figure out the constructive retirement, we're going to need to, it's useful to go ahead and sort of go through a pro forma retirement entry to figure out how much of a gain or loss would there be on retirement. So let's go ahead and determine that. These bonds had a face value. Okay, now the total face value was $200,000. We're only retiring, or the related parties only buying back half the bonds. And so it might be nice to go ahead and list both the full face value as well as the portion being retired. The remaining premium, again, there was a $4,000 premium. It's being amortized at $400 per year. And how many years have elapsed? 2012, 13, 14, 15, 16, and 17. So 6 years have elapsed. There's 4 years left. So the remaining unamortized premium is $1,600. For the portion that's being retired, that's $800. And so the carrying value of these bonds total $201,600, and that's pretty much irrelevant. What we're concerned with are the ones that are being retired, and these are being bought for $103,000, which means there's going to be a loss on retirement. Again, we're buying back bonds with a carrying value or a book value of $100,800. We're buying them back for $103,000, so we're paying $2,200 more than carrying value. So we're going to have a loss on retirement. And now once we do that, we sort of know what we should be expecting. Let's go ahead and make up our shopping list of the accounts on the books of Big the issuer and Little the buyer. Big the issuer. At December 31st, when we're making our first elimination entries, Big the issuer has bonds payable of $100,000. Again, we're concerned with the ones that are being retired. And these bonds have a premium of $800. And so these accounts need to be eliminated. Now, Big also has interest expense for the year, but that interest expense was paid to and incurred with some unrelated third party. We're only interested in the related party aspects of this relationship. So although Big has interest expense, it wasn't incurred while Little owned the bonds. So let's go ahead and see what Little has. Little the buyer. They've got investment in bonds of $103,000. So when we do our elimination entries, basically we're going to close these against these. That'll be very straightforward, simply swapping, closing one against the other, nice and neat. When we do our elimination entries for this, we're going to have to eliminate these accounts, and obviously these aren't going to balance out to each other. The difference is going to be that loss on retirement. Now, one thing that's sort of unusual if you think about it is that in the case of intercompany asset sales, the problem was that one of the two companies had a gain or loss on their income statement which hadn't been realized, and our job was to eliminate it. In this case, that's been turned around. Now, neither individual company has a gain or loss on their income statement, but the consolidated entity does have a gain or loss, which we need to put on the books. Now, in the case of the intercompany asset transactions, the gain or loss was recognized via an adjustment to depreciation expense, for example, over the life of the asset that had been sold. In this case, again, we've got a $2,200 loss that is being reported by the consolidated entity, but not by the individual companies. So how will the individual companies reconcile that? How will that be reconciled? How will the individual companies report the expense that the consolidated entity is already reporting? That's going to be done through the relevant or relative interest revenue and interest expense of the two companies. Again, $2,200 loss on retirement. These bonds have 4 years left to run. So that $2,200 is going to be recognized over 4 years at $550 per year. Let's go ahead and see how that's going to work out. Let me insert a text box here. And let me adjust the formatting here so it doesn't give me double spacing, which uses up all my available space. Okay, what is Big the issue we're going to have as interest expense? They're going to have their coupon interest of $10,000. The $800 premium on the related party bonds, that's going to be amortized for the remaining 4 years. So there's $200 of premium amortization per year, and amortizing a premium reduces your interest expense or interest revenue. So they're going to have interest expense each year of $9,800. Little the buyer is going to have interest revenue, again, $10,000 of coupon interest. Little has a $3,000 premium that's going to be amortized over 4 years at $750 per year, and that $750 of premium amortization is going to reduce their interest revenue. So they're going to have interest revenue of $9,250. Obviously, $9,800 minus $9,250 is $550. A dollar sign there. And so each year, that loss is going to be recognized by Big having $550 more interest expense than Little has interest revenue. So at the end of the 4-year lifespan, the total income on the individual companies combined, as far as this bond is concerned, is going to equal that $2,200 loss. The consolidated entity is showing the entire $2,200 loss up front. The individual companies are showing net interest expense of $550 per year for 4 years. Okay, so let's go ahead and run through the equity method entries and the elimination entries using the method that we've used in class. As far as our equity method entries are concerned, let's go ahead and dispense with the income and the dividends, because that's the same as it always is. And let's focus instead on the equity method entries that are related to these intercompany bond transactions. Okay, the first of them, the issuance directly to the related party, that has no effect on earnings. Again, we've got $10,000 of interest expense, $10,000 of interest revenue. It's a wash. There's no effect on income. For the constructive retirement, there is going to be an effect on income. Basically, we're going to be going ahead to record a $2,200 loss on retirement, and the parent needs to record their share of that loss in their equity method entry. So this is a downstream sale. Again, it's because the parent was the issuer, this is viewed as a downstream transaction, which means that the parent absorbs 100% of that $2,200 loss. So investment income reduced by $2,200, investment in little reduced by $2,200. Now let's go ahead and do the elimination entries. I can't stress enough the importance of keeping distinct, both in your mind and also in any work you do for somebody else, that you need to keep clear the distinction between the equity method entries, which are how the parent accounts for their investment in their books, and the elimination entries, which are simply a worksheet entry or worksheet entries. It's very, very important that your reader know which ones are which, and that they're separate groups of entries. In any event, for our elimination entries, again, using the approach that I've used throughout most of the class, first we'll do our S entry. We're going to go ahead and eliminate the subsidiaries beginning of year common stock and retained earnings. There is no differential, there's no excess value, so basically that's it for the debit side. And we're going to take that $400,000 and split it 70-30 between the parent's investment in little and the non-controlling interest. A for amortization, not applicable. I for investment income. Now we didn't do the equity method entries except for the one related to this intercompany bond transaction, but in this case it'd be fairly straightforward to sort of determine the investment income without too much trouble. The parent is going to receive 70% of the reported earnings, or $70,000, minus that adjustment of $2,200. So the investment income, $67,800, that would be eliminated, and we close that against the investment in little, $67,800. D for dividends, I'm just going to skip that and say that's the same as always. We've done that repeatedly. Now we have our intercompany transactions. I think we have two intercompany bond transactions. The issuance directly to the related party is going to be really easy. Basically, we've made up our little shopping list of what accounts there are on the books of the two companies related to this bond issue, and all of those accounts have to be eliminated. So we're going to go ahead and debit bonds payable for $100,000, and we're going to debit interest revenue for $10,000. And that's going to be matched by eliminating the investment in bonds for this $100,000 and the interest expense for $10,000. Okay, and again, that's going to be the same entry year after year after year for as long as the bonds are outstanding. The other intercompany transaction is going to be a little bit more involved, and again, we very conveniently and with great foresight listed the accounts related to this bond issue on the books of Big the issuer and Little the buyer, and basically we say, look, from a consolidated standpoint, this bond issue does not exist anymore. We've got to get rid of those accounts. So we're going to go ahead and debit bonds payable. We're going to go ahead and debit premium on bonds, the remaining balance there, $800. And we're going to go ahead and credit investment in bonds. Now, of course, the problem here is that this entry doesn't balance. We're missing $2,200 on the debit side, and that missing $2,200 is going to be the loss on retirement of the bonds. Finally, we do our income to the non-controlling interest, and again, they're going to get their share, 30%. We start with the reported earnings, and then we ask ourselves, how did these elimination entries affect earnings from the subsidiary? Of these entries, the only one that has an effect on income is that. But again, this was a downstream transaction, so it doesn't affect the non-controlling interest. So basically, they're going to get their share, 30% of the $100,000, and that's it. Okay. Okay, following year. Let's think about what's going to happen the following year. Again, let's go ahead and I can't stress enough the prudence and usefulness of making up this list of accounts that's going to be on each of the two companies' books related to this intercompany bond issue. First, they're going to have these same accounts they had previously. They're going to have, for the bonds that are sold directly to the related party, they're going to have the bonds payable and interest expense, and the investment in bonds and the interest revenue. That's going to be identical year after year after year because there was no premium or discount being amortized. But now let's go ahead and focus on these balances. What are they going to look like next year? The bonds payable is still $100,000. The premium now is down to $600 because another year's worth of amortization. Additionally, Big the issuer has interest expense related to this intercompany bond relationship. Interest expense, we've got that right over here already, $10,000 coupon minus $200 of premium amortization for $9,800. By the same token, little the buyer, their $3,000 premium on their investments being amortized at the rate of $750 per year. So the investment in bonds is now down to $102,250, and they've got interest revenue. Again, coupon minus the amortization of that premium, $9,250. So let's go ahead and go through our equity method entries and elimination entries for year 2. First, for our equity method entries, again, income and dividends, that's going to be the same as it was before. Let's skip that. Let's just focus on, so income, dividends, skip. Let's focus on the intercompany transaction. When we do our elimination entry, we're going to be eliminating these accounts. What effect will that elimination have on our income? Basically, we're taking away $9,800 of interest expense. We're going to be increasing income by $9,800. Then we're going to go ahead and take away interest revenue of $9,250, so we're going to reduce it by $9,250. So the net is going to be a $550 increase. So our equity method entries, we're going to go ahead and recognize the parent's share of that $550 increase. And again, this is a downstream transaction, so that $550 will all accrue to the parent as an increase in their investment income. Now, note what's going on between last year and this year. Last year, scrolling up, my apologies, we took away $2,200 of investment income. We said, look, you've got this loss that's been realized, but you haven't recorded yet, so we're going to have to reduce your investment income by $2,200. Now, as it's getting realized, we're giving it back. So we took away with a debit $2,200 the first year. For the next 4 years, we're going to give it back by crediting investment income for $550. Our elimination entries. Okay, and again, I'm just going to copy these and change the numbers as appropriate. Okay, the first one. Retained earnings the second year will have risen. Last year's retained earnings was $350,000. Beginning retained earnings was $350,000. They made $100,000. They paid $20,000 in dividends. So this is now up to $430,000. So the total book value of the subsidiary on January 1st was $480,000. And that $480,000 is going to be split 70-30 between the parent and the non-controlling interest. So 70% or $336,000 is going to go to the parent. The other $144,000 is going to go to the non-controlling interest. Their investment income. Again, the parent's investment income is going to be their share of the reported earnings, $70,000, plus or minus this adjustment. So $70,000 of investment income plus, with a credit, an additional $550. So we got $70,550. D for dividends as always. And now we come to our intercompany bond transactions. This one, exact same as it was last year. Again, this one was, these bonds were issued at face value, so there's no discount or premium this being amortized, so that's going to be nice and straightforward. For this one, again, let's look at it'll all fit here. We've got our list of accounts that are on the ledger related to this intercompany bond issue, and those all have to be eliminated. So just one by one. Bonds payable, $100,000 being eliminated. The premium on bonds is now down to $600. Investment in bonds, $102,250. But now, in addition, we've also got the interest expense and the interest revenue. Now, interest expense is a credit balance account, so to get rid of that, we're going to credit interest expense. Interest revenue is a debit balance account, so to get rid of that, we're going to, interest revenue is a credit balance account, so to get rid of that, we're going to debit interest revenue. Now, again, this thing doesn't balance. What's missing is the gain or loss that we're carrying forward from last year. Now, again, last year, scrolling up again, last year we showed a $2,200 loss in retirement, and recall that we discussed we were going to recognize that over the next 4 years at $550 per year by the disparate interest revenue and interest expense of the two related parties. In the first year, there was no intercompany interest revenue or interest expense that first year because the bonds were bought on the last day of the year. So we're carrying forward a $2,200 loss, and just as was the case with our intercompany asset transactions, we had two questions we had to ask ourselves. First, was this an upstream or a downstream transaction? This was a downstream transaction, so the non-controlling interest is not involved. Second question was, is the parent using the full or the partial / modified equity method? They're using the full equity method, so when we carry that forward, we're going to go ahead and debit or credit, as appropriate, the investment in little account. So what's happening here is we're carrying forward a $2,200 realized but unrecorded loss, of which $550 is being recorded this year by big and little individually. We go to do the income to the non-controlling interest, and that's going to be the exact same thing as it was previously because, again, this was a downstream transaction, so it has no bearing on the non-controlling interest. I do want to go ahead and go on to year 3 just to sort of make an observation. Year 3 question mark. Recall that in year 2 we had this. Let's just copy that up there for purposes of discussion. This is what we had in year 2. Think of how this is going to carry forward to year 3. Again, I'm just going to copy and paste and change the numbers as appropriate. What's going to change? What's not going to change? Bonds payable, still $100,000. We're using straight line amortization, so interest revenue and interest expense are going to be the same as well. What's going to change is the premium. The premium is being amortized at $200 per year, so the premium's down to $400. The investment in bonds, that premium is being amortized at the rate of $750 per year, so this is now down to $1015. And finally, the amount of the realized but unrecognized loss being carried forward is now down to $1,650.